The amortization period refers to the total amount of time that it will take to completely repay a mortgage loan. For example, if the amortization period is 25 years, then the borrower will be making payments for 25 years and paying a lot of interest along the way. In this mini lesson, we'll discuss accelerated mortgage payments, which can save a borrower thousands of dollars in interest, not to mention get a student a mark or two on an industry exam. When applying for a mortgage, the borrower can usually select from various payment frequencies. Now, the default payment frequency is generally monthly, but the borrowers can have this converted to other frequencies, such as accelerated weekly or accelerated biweekly, which is every 2 weeks. Now, this concept is so much easier to understand if we use nice, low, rounded numbers. If you look to the side of me, you'll see a table with different payment frequencies. Let's assume the monthly payment on the mortgage loan is $1,000 per month, and fill in the rest of the table together. To calculate the accelerated weekly payment, we take the monthly payment and divide it by 4 because there's typically 4 weeks in a month. So the accelerated weekly payment would be $1,000 divided by 4, which equals $250 per week. Now let's calculate the accelerated bi-weekly payment. We take the monthly payment and divide it by 2 because there are typically two 2-week periods in a month. So the accelerated bi-weekly payment would be $1,000 divided by 2, which equals $500. An interesting thing comes to light when we fill out the total annual payments. 12 monthly payments times $1,000 is $12,000. 52 weekly payments times $250 is $13,000. And 26 bi-weekly payments times $500, also $13,000. Notice that with accelerated weekly and accelerated bi-weekly payments, an additional amount equal to 1 full month's payment is being paid each year. For many people, making 4 weekly payments of $250 doesn't feel that much different than paying $1,000 per month. In fact, they may not even realize they're making a full extra payment each year. Over the life of the mortgage, this can significantly shorten the total repayment period and save thousands of dollars in interest. Now, if you're thinking, why do they calculate it that way? Why don't they just take the total annual payments of $12,000 and divide it by 52 weeks to get a weekly payment of $230.77? Well, they can, but that's the calculation for regular weekly payments, not accelerated weekly payments. Recall from an earlier video that the Hens selected a 25-year amortization period, which resulted in monthly payments of about $2,656. Over the life of the mortgage, assuming interest rates don't change, they would have paid $371,903 in interest. Now, to really put the benefits of accelerated payments into perspective, let's see how the numbers would shake out if the Hens selected an accelerated payment schedule. So if instead of monthly payments they selected accelerated weekly payments, each payment would be $664.09, which is $2,656.34 divided by 4. Their mortgage would be paid off about 4 years sooner, and they'd only pay $302,635 in interest. The accelerated weekly payment option would save them more than $70,000 in interest. Now, I should point out that the number of years that are shaved off the total repayment period, along with the interest costs, will vary significantly depending on the mortgage rate. But one thing's for sure, accelerated payments can potentially save the borrower thousands in interest. Accelerated payments and an acceleration clause may sound similar, but they're actually completely different things, so it's only fitting that we touch on the acceleration clause in this video as well. Most mortgages have an acceleration clause, which comes into play if the borrower defaults on payment. When a borrower is in default, the lender reserves the right to make the entire mortgage balance, which includes the outstanding principal and accrued interest, immediately due and payable. In other words, the lender can accelerate the requirement to pay the mortgage in full. This provides an added incentive for borrowers to make the payments as agreed.